So the guys who are buying stocks right now thinking, oh boy, rates are going to go down, which they are on the long end because the bonds are rallying. Okay. It's not going to last. And even if the Fed does shift policy, it's not good for you guys. They don't know that. They haven't gone back and looked at history, 2000 top, 2007 top. So anyway, I think the stock market rally is delusional. And I strongly suspect that it's going to roll over, and by year end and early next year, you'll see the pain start to come to the stock market in ways that people finally say, oh gosh, we got fooled.
On this episode of the What the Finance podcast, I have the pleasure of welcoming on Michael Oliver, who's the founder of Momentum Structural Analysis. So Michael, thanks so much for coming on the podcast again.
Great to be back, Anthony.
No problem, and I'm looking forward to it. So, from your perspective, what are you currently seeing in the markets? Because I know last time we talked, you said you thought that the S&P and other stock markets had got into a high. You were saying that you thought maybe bonds were sort of reaching a bottom, but then obviously we've seen them go down further. So, what are you currently seeing at the moment, and why do you think, or the last 6 months of it, why that's happened?
Well, our stock market calls over the past 30 years. The MSA started in 1992, so 31 years. Have all been good, very good. We can document it, okay? In 1995, for example, in February, stock market was in sort of a range-bound situation. We said, this is going to be a major explosion, okay? We didn't turn bearish until January 2000. And we said, okay, we think it's time to get out, but it's not going to fall apart right away, we said. It's going to linger up here for a while, but, expect it to be a top. It was. 2002 low, we called the low in July. We said, this is a major low. In fact, it came back down in October and nipped it out just a bit and then went up. Okay, 2007 and so forth. So, okay, in January of 2022, focusing primarily on the NASDAQ 100, which was the leader index in terms of percentage gain. For instance, the S&P from 2009 to 2021 went up 7-fold. Never had a bull market that big in U.S. stock market history, in a plus 12 years, long duration. But NASDAQ 100 went up 16-fold. Whoa. You talk about a bubble. Okay. All during that time, we know what was the primary cause. You look at an M2 chart and you can see money supply exploding continually. And you look at a Fed funds rate chart and you see it on the floor, comatose. Effectively free money, okay? You have free money for 12 years, okay? Party time, okay? The bubble broke early last year. And ever since then, if you look at the U.S. stock market metrics like S&P 500 or NASDAQ 100, they went down through October of last year. So they had a pretty good percentage drop, initial arm wrestling drop of a bear market. They've spent they went from October low last year up to July high of this year. They couldn't get back to the highs. They went back up to the price levels, in fact, where we had said, okay, get out, be gone. Okay. Heck, back in 2000, when the market topped, they actually went up and made a marginal new high in the summer of 2000. It didn't last. I mean, it's still a huge bear. But when you look at most of the sectors within the S&P, exempting tech, eliminate tech, okay. You look at things like healthcare, financial sector, banking sector, utilities, even consumer discretionary, which is what's called most people term it a high risk, but the kind of sector you want to be in during a bull market because it leads. It's full of the consumer discretionary stocks. In fact, Amazon is promptly weighted within XLY, for example. But even if you look at that sector, which is a risk-on sector, meaning a leader, it's not leading anymore. It doesn't even look like the S&P. S&P went back up to 2/3 of the way to its high, and XLY ETF is still in the lower half to a lower third of the past 2 years price range. So we suggested if you're looking at the stock market, don't look at the S&P and the NASDAQ 100 because they're too front-end weighted with Apple, Microsoft especially. And those two symbols, they look great, right? But that's not the world. But when you look at the, quote, broad indices of the S&P 500 and the NASDAQ 100, they totally distort those indexes where nothing else in the market looks like them. Okay, so that's our stock market reality from our perspective. During a good chunk of the stock market's dropped from 2022 high to the late 2022 low, T-bonds had already been in a bear trend, meaning prices coming down. I'm talking U.S. government bonds now, and yields going up. This past summer, we put out a report saying the T-bonds were going to have a nuke event, downside nuclear event, and they crashed. T-bonds effectively, if you look at a price chart of T-bonds, you'd think you're looking at some commodity, limit down almost, a huge straight down decline. And what's so funny is that it wasn't a broad bond market event. It was U.S. government bonds. We started to look like Japanese bonds during the summer and into the low last month. But you look at things like muni bonds, they only marginally went down and took out last year's low, where the T-bonds crashed through those lows. And if you look at high yield corporate debt, which doesn't look good, but it didn't take out those October lows of last year. So the T-bonds in and of themselves were in a crash mode. Well, what does this mean? We thought it would lead to a V bottom, where you would get a major counter trend rally in bonds. And I think we're in the process of seeing that now. It's not going to last, but that market was vastly oversold. But the fact that the T-bond market did what it did, way beyond what the Fed would like to have seen. They like to play this incremental game on the shorter end of the market, which, by the way, is no issue. It's over. They're not raising rates again, okay? Why? Because their T-bond market crashed. They cannot afford to not defend government debt. And the T-bond market put them in a position where, even though they won't admit it publicly because that would admit fear, they have to, at whatever cost, defend government debt market. However much money they have to print to buy those bonds, they're going to have to do it. Well, who's the beneficiary of this? Gold. Every time the central bank goes from a boom to a bust back to a boom cycle, where they deem that they have to print money to save a given asset category that they save, like the stock market or the bond market, the money flow goes ultimately into monetary metals. So we think the prime beneficiary of this process, this transition of the Fed back to monetary easing, is gold. And that's probably the reason. If you look at take a monthly bar chart of gold, go back to the 2015 low, for example, when it was $1,000, $1,050. Okay, it doubled by 2020, had a sharp drop, came back up in 2022, had another real sharp drop. I say sharp, I mean 20%, if you call that sharp. Okay, and then you come back up here early this year again to well over 2,000. And then you, for the last, through last month, you had a pullback that took you down into the 1800s. And now you go back to 2000 again recently. What's going on here? How come gold keeps going back to 2000 plus? What does it know? Who's buying it? Yeah, it seems to be capped, but you look at the history of gold, there's never been a pattern where gold's gone back to the high, back to the high, back to the high, back to the high. It's telling you it's going through. And we think gold is going to launch shortly. Why? Because of the fundamentals I just described, monetary fundamentals.
Okay, no, that makes sense. So if we start with the stock market, so you're saying that, I guess, yeah, as you said, Apple and Microsoft are sort of at least keeping up the large indexes like S&P 500, NASDAQ. But if you look at the Russell 3000, that's completely different. Other indices are different.
Small caps and mid caps are laying on the mat. It's like they made their low in 2022 and they're just laying there, hemorrhaging. Okay.
Yeah. So do you think there's a risk that maybe those big indexes remain quite stable because of the influence of these large or massive caps, and then maybe we see it in those other indices, or do you see them coming down as well?
I think what you're seeing now in the S&P is very similar to what happened in the 2000 top and the 2007 top. Let's go back and look at history. Prior to the 2000 top, and we got bearish in January, said, though, it labored for a while. It labored for a year, okay? And it more or less went sideways, okay? The Fed had been raising rates for a couple of years prior to the 2000 top. So in other words, the market had gone up despite the fact Fed had been raising the Fed funds rate. It ceased raising them in May of 2000. Okay. Now the stock market after that went up, made a marginal new high. I'm talking S&P 500, not the NASDAQ 100, made a new high monthly close in August of 2000. So after the Fed ceased raising rates, the market said, oh boy, okay. And started to roll over into December of 2000, putting it back near the lows of that year. First day of January 2001, the Fed cut rates 0.5%. Did the stock market, it had a rally after that, a couple of weeks. What happened after that? Stock market entered the real sharp phase of the bear trend. Fed cut rates all the way down. And the stock market went down to 2002 lows, despite the Fed cutting rates. In fact, the NASDAQ 100 went down 80%. Okay, go to 2007. The Fed had been raising rates, I think, from 2005 to 2006. Stock market went up anyway, okay? But it leveled off. And it was December of 2006, we put out a report saying we think the market's going to top next year between 1550 and 1600, talking S&P 500. In in September of 2007, the S&P 500, again, different from what most of the indices look like. If you look at banks then or financials, they were on the mat, just like they are now. But S&P was up there beating its chest near its old highs that had occurred in the spring of 2007. The Fed cut rates in mid to late September 2007. Stock market went up for about another 2 to 3 weeks on the joyous news of the Fed rate cut, right? And that was the top in October of 2007. By December, stock market was back down and we got major bearish in January 2008. And yet the Fed cut rates all the way to the bottom in 2009. It didn't help the stock market. In fact, had you sold the first rate cut, the shift in Fed policy from raising to cutting, you nailed the top. So people who think now they're buying the S&P, for example, on the assumption because of what happened a week or two ago when Powell basically sort of hinted at surrender, like, we may or may not raise rates. But the consensus among analysts and portfolio managers was, they've quit, they're through. So the public consensus was, okay, Fed's not going to raise anymore probably. Therefore, it's party time. And so you've had a party for the last couple of weeks in the S&P. No, you're not back to the highs, nor is NASDAQ. But most of these indexes, the subsectors in the broad market, look like hell. They're laying on the mat. Small caps, mid caps, all the sectors I mentioned. But the S&P's having a party, just like it had in September of 2007 through October 2008, where they cut rates. Now the fact that there's sort of a surrender flag and they're not going to raise rates, or at least that's the consensus, it's likely justified. People are partying. Don't party, because when the Fed shifts from a rate rise policy to a more accommodative outlook, and now there's talk that next year they'll be cutting rates again. You know, the analysts are saying, well, maybe mid next year they'll cut rates. I'll bet they are, okay? They're right on that. But it's not party time, because whenever the Fed does that, they're admitting something. And I think what's got them really spooked are not so much the data points that they want to say, oh, look, the economy's weakening some, so we can level off here. It's the crash in their bond market. I mean, they got to have blood coming out of different parts when they're watching their bond market go into a Japanese bond market type crash. So I think that's the overriding thing to look at right now. And by the way, it's another technical point we make a year ago, in fact. The synchronicity between T-bonds and gold has been pretty good. Now, this isn't true most of the time. Most of the time, bonds will go opposite price-wise, opposite the price of gold. But since last October's low, T-bonds had a good rally, very substantial rally. And so did gold. Gold had a major rally from the 1600s back over 2000. And then early this year, if you look at T-bonds, like back in March, and look at gold back in March, they crested. And T-bonds went down slowly. Gold went down very slowly. But T-bonds crashed. And gold didn't crash and go back to its October lows, which would have been in the 1600s. Instead, it went to the lower 1800s. And they got slightly out of sync at that point because gold exploded starting in early October. And T-bonds, we thought, would probably follow gold, but they were lagged this time by about 3 weeks. And all of a sudden, the T-bonds are now starting to explode like a V bottom in price. So they're getting back in sync with gold. And I don't think this synchronization will last, by the way. The T-bonds ultimately are a bear. But I think you're going to get a nice rally here. And I think probably one of the causes is, without stating it, the Treasury and the Fed's got to be supporting that market in the dark or whatever. And there's a lot of big asset managers, too, that realize that the normal alternative to the stock market, you know, the 60-40 portfolio mix, stocks and bonds. Suddenly, last year, of course, bonds were terrible. They were worse than the stock market. So that balanced portfolio was very dangerous. But suddenly now T-bonds look like they could actually go up. So the guys who are buying stocks right now thinking, oh boy, rates are going to go down, which they are on the long end because the bonds are rallying. Okay. It's not going to last. And even if the Fed does shift policy, it's not good for you guys. They don't know that. They haven't gone back and looked at history, 2000 top, 2007 top. So anyway, I think the stock market rally is delusional. And I strongly suspect that it's going to roll over, and by year end and early next year, you'll see the pain start to come to the stock market in ways that people finally say, oh gosh, we got fooled. Okay. And meanwhile, the gold pullback, we think that low we made last month at 1826, within 16 trading days, gold was back over 2,000. And it wouldn't shock me to get back over 2,000 again pretty quickly here, and then probably launch. But I think the main driving factor here is, again, the central banks of the world have to revert to what they do best, and that's print.
So if they were, as you said, if they were to start to cut rates and they were to start to print, generally has that not generally been quite good for, I guess, equities and other risk-on assets, or no, not to begin with?
Just like in the 2000 top and the 2007 top into 2008, the Fed cut rates all the way down in those bear trends. In fact, you could lay the price chart on a Fed funds chart. Even though Fed funds were collapsing, stock market was collapsing. Once the bubble breaks, the Fed tries to stop it once they perceive that it's breaking, okay? And what's really smacked them in the face isn't so much weakness in the stock market, because that's been gentle, arm wrestling type stuff, which is what we expected in the first phase. But the bond market crash, that upsets them more than anything, more than any data point out there. They can't have their market crash. And that's why I think you've had this sudden reversal in the bonds, as I strongly suspect, and I can't prove it, but you know damn good and well the Fed's been in there buying in the dark, and the Treasury supporting their market. They have to. They have no alternative. It's a nuclear event. And I think they put the brakes on it. And technically now we define the bonds as back into an uptrend on an intermediate basis, not long-term. This rally in bonds might last for a handful of months where you stay off that low. Ultimately, it's going to fail and roll back over, and rates will go back up. But right now, I think the bonds are, on a trading perspective, a decent place to be. It's not going to sustain, but that's not going to help the stock market. In fact, if you go back and look at the T-bond market during that same time period, like in September, October of 2007, when the Fed cut rates, stock market peaked and went down, bond market went up, yields dropped and continued to drop. So the direction in rates will not save the stock market.
Okay, makes sense. So what did you see in summer that made you sort of concerned about, I guess, the government bond market?
What has me most concerned?
So if we are in summer, when you sort of said that you think it could break down further, why did you think that was the case?
Well, I think, obviously the debt market, the collapse in T-bonds upsets a lot of tables. Tables get flipped over, all kinds of assumptions, whether portfolio managers in the stock market, whether he's in the financial sector, for example, which is an ETF we're watching very closely, XLF. We know the banks have crashed, okay? You know, they crashed back in March. In fact, in January, we put out a report, late January, we said, watch out, there's a bank ambush coming. And we didn't know why. We could just see it technically. And sure enough, by March, it was a crash. By crash, I mean, you dropped 30% rapidly, okay? And it did. And the bonds are below, well below the 2022 price lows. KBE, for example. So, S&P 3,500 was last year's low, and it's trading at 4,400. So it's still above it. But when you look at a lot of the sectors, they're not. And I think what upsets the Fed more than anything will make them panic, ultimately not just pause, but reverse cut rates and go draconian the other way again, is what happens in the financial sector of the stock market. They don't care about NVIDIA, or Tesla. They care about financial institutions. And if you go punch up the XLF ETF and look at it, compare it to the S&P, they don't look the same. One's on the mat, one's not. But you go within XLF and it's got banks, insurance companies, asset managers, credit card companies, sectors that are very important for the Fed. Now, also, if you'll go back and look, now the Fed liked to blame that March crash in bonds on a couple regional banks. And they said, oh, mismanaged banks. In other words, it wasn't our fault, the Fed, to create a problem for the banks. It was mismanaged by some dumb, medium-sized regional bank manager. Great excuse. A lot of people believed it. I didn't. A lot of people didn't. Look at the too big to fail banks now. For example, I suggest punching up Citicorp and Bank of America. Punch them up on a price chart. Momentum-wise, they're going down. Okay, but when you look at a price chart of Citicorp and Bank of America, two of the top 10 too big to fail, and look at an S&P chart and then look at their chart, you say, my goodness, what's going on here? What have I been drinking to delude myself that the stock market's okay? When Citicorp and Bank of America are on their example, the close of Citicorp last month, looking only at month-to-month closes, was the lowest price close for Citicorp since an aberrational low close that occurred in early 2016. So it took out 7 years of prior monthly closing prices. And if you eliminate that one little drop we had in 2016 and go back to 2011 to find lower closes in Citicorp on a monthly basis. So from 2012 to the present, 11 years, with the exception of that brief drop in early 2016, that's where Citicorp is. What's going on? How come the Fed's not talking about this? They're talking about it behind closed doors. So, if you're looking at data points thinking that's what's going to influence the Fed, forget it. Look at Citicorp, look at Bank of America. And there's some other ones that aren't looking too good either. Morgan Stanley and Goldman Sachs. Their price charts look very vulnerable. So if I were watching the stock market right now and trying to understand what's the reality going to be like in the coming months, the reality I'd be looking at are banks, the big ones. Because as they go, the world goes. And also I suggest, again, if you go back and look at 2007, well, the S&P was beating its chest in the latter part of 2007, near and marginally new highs. Look at what financials and banks were doing at the same time. They were oozing and oozing and oozing. Total different direction. So they weren't crashing, but they were going down. And the S&P was up there at its highs, and the banks were saying, That's where we are now. It's the same technical situation. The only problem this time is the bubble back then in the stock market was only 4 or 5 years old. And it only involved the S&P doubling in price. Okay. Yeah, we had a real estate bubble. But in the 2021 high, the S&P was up 7-fold over 12 years. NASDAQ 100 up 16-fold over 12 years. The bubble is far, far bigger. So when it breaks, the repercussions are going to be bigger. So it's good. 2024 is going to be a fun year if you're on the right side.
Yeah, no, definitely. So you said that you think that bonds will maybe go up in the short term, but then further depreciate in the long term.
Yeah, I don't try. When we run things like, we don't look at price so much as we look at it secondarily. Everybody looks at price. Okay. Even the price charts of bonds are broken. Or if you look at a yield chart, for example, going back 40 years, you'll see a big downtrend line on yields, which the recent yields broke fully out above. So even the yield chart says, yeah, you broke your trend, dropping yields. You're now into a positive yield trend. And it went a long way. That was a huge surge in yields. And if you look at the yield chart and say, that's a price chart, it could pull back some. It could have a counter trend pullback in yields, or bonds have a price rally. But it's just a counter trend rally. It's not going to sustain, and ultimately the bonds will roll over again, meaning even with this, it's doubtful they're going to win. They'll win in the short term, because technically it's frankly justified for bonds to rally. You don't inhale forever, exhale forever. All markets inhale and exhale. So bonds are now having an exhale counter to their primary downtrend in price, and enjoy it. It won't last. But I think part of the reason for that bond rally is the rollover in the stock. It has been occurring since the summer highs. S&P then was at 4,600. Right now, I think we're trading in the high 4,300s, 4,400, even on this rally. So the intermediate trend of the S&P has rolled back over to rejoin its long-term trend, but the annual momentum trend of T-bonds, by measuring it on an annual momentum basis, not price, is negative. So the rally we're getting in price now is counter to the long-term trend. Anyway, but ultimately, when this all filters out, I think gold will be the leading market to be in, gold and silver. In other words, monetary metals. So I emphasize that, not precious metals. I don't include platinum in the group or palladium. Okay. But I also think commodities will benefit from this. Lag to the gold market. But when you look at commodities on a long-term basis, even just a price chart, they complained last year that, commodities are exploding. Yeah, that's a year-over-year measurement. But when you look at like the Bloomberg Commodity Index, BCOM, it rallied from a low last year in the 60 area. When it turned up through 70, we put out a report saying there's a commodity explosion coming. That was in October of 2020. They doubled. By the time the war in Ukraine, Russia-Ukraine war started in February of 2022, the commodity boom lasted another 2 to 3 weeks. That's all. So the Fed wanted the blame and the government wanted the blame. Oh, it's the war in Ukraine that caused grain prices to go up or oil to go up. Baloney. Their move had already occurred before that war event even began. And since then, commodities have pulled back. But okay, look at the price now, Bloomberg. It's trading 103, 104. Okay. If you go back to 2008, when commodities were in a big bull, they were 237. So you look back the 15 years and we're at 103 and we're at 237. Commodities are hardly highly priced relative to their historic norms. And then they had a secondary rally in 2011 when commodities peaked at, I think it was around 170 something, Bloomberg. Again, it's at 100. So there's two peaks, 2008 and 2011. We're not even near them. So people who think that commodities are overpriced, no, it's an asset category that's still vastly underpriced. And so I think when the Fed does shift back, and I suspect they already have, toward monetary easing, the prime beneficiary would be the monetary metals, but secondarily, a much depleted asset category, commodities and commodity-related stocks. And I tend to have a bias that while energy led that first surge in commodities, the one from late 2020 to 2022, energy was a major component, oil and natural gas. I suspect that food commodities will be a primary leader in the next wave up. So grains are depressed right now, corn, wheat, and soybeans. I'd watch them because I think in the next upturn, that's probably the subcomponent of commodities that will be the leader in that category.
Okay, that makes sense. So, Michael, thanks again for your time today. I really appreciate it. My last question is, what is one message you like people to take away from our conversation?
2024 is going to be an interesting year. And there's a variable that nobody talks about that's going to suddenly be front and center, and I suspect within a few months. And that is, there is no copacetic, placid, hug around the neck outcome to the 2024 election. No matter who wins the election, there will be discord, untold disruptions, and a sense of, my goodness, what's going on? That is not priced into the markets. It's hardly even discussed. Everybody knows we're, quote, a nation divided. There's no good outcome to the next election, no matter who wins, in terms of the other side being copacetic. Price that into the market. I think that will begin to be priced into the market probably early next year without even waiting for the outcome of the election. So So that's a variable to watch. And then go to Oliver MSA if you'd like some sample reports. Oliver MSA. Thank you.
Yeah, perfect. So that'd be the best place to find your works. Yep. Michael, thanks again for your time.
Thank you, Anthony.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.